So I'm really pleased to introduce our first panel for today on financial factors that are driving transmission investment. I think this is a really important topic that not everybody understands as much as they probably need to in terms of how it factors into issues around using capital, where do you deploy capital, how you make decisions around projects, and what some of the regulatory consequences are associated with all of that. And we have a fantastic moderator for this panel, former FERC Commissioner Phil Moeller, who's really been an outspoken champion of sorts on trying to raise awareness of this issue and focus on the importance of the investment community to the regulatory process. So in a lot of ways, he's the perfect person to actually moderate this panel. Phil's been, as I mentioned, a former FERC commissioner. He is a former EEI executive, and he's an industry leader and a good friend as well. So really appreciate your being here. I'm going to let you introduce the panel and kick off the discussion. I know at a certain point, similar to the commissioner's comments earlier, we're going to open it up to folks for questions from the audience. So again, I'm going to encourage everybody to start thinking about questions they would have for the panel to discuss. So with that, let me go ahead and turn it over to you, Phil.
Well, thank you, Larry. It's a thrill to be here. Thank you for Wires inviting me. It's nice to see a lot of old friends, meet some new ones, and to talk about this topic that you mentioned is so important. And when we talked about this last summer, or last spring when we were setting this up, we thought this is an important set of issues. It's a particularly important set of discussions on these issues at this time. As you noted, I was with EEI a long time, and I really built on the efforts of my colleagues there, particularly David Owens, who apparently has stepped out of the room, but is kind of a legendary guy, where we tried to demystify, particularly for state regulators, the role of the financial community, especially the rating agencies, because for some reason state commissioners were particularly intimidated by spending time with rating agencies, which really didn't make sense. So we made a big effort through our meetings we'd have every year in New York City, where we bring in state regulators to all the various NARUC events, where I think we were effective, even though it's an ongoing issue with the turnover of state regulators, in demystifying a lot of the investment community, including the rating agencies, as part of the major players as these investments are made. So felt good about that. It's ongoing. But this is a period of transition that's particularly crucial. I think back on probably the first major transition that I went through was I spent 6 summers as a machinist in a salmon cannery in Petersburg, Alaska, where we would can salmon. And during that period of time, the Norwegians figured out how to farm salmon, which completely changed the salmon industry. And, you know, it used to be kind of a specialty you get once a year. And, you know, now you can get it anywhere, anytime. So I've been through a major transition, aquaculturally related, but nevertheless somewhat relevant as to what we're going through now. Well, I'll ask each of our panelists to introduce themselves and give a little background on how they got to where they are. I think you as an audience deserve to know from our panelists how their career trajectory to get them to this point. Then we'll go into some questions specifically about what they do, how they do it, how that impacts perhaps Obi's ratings, how that impacts how Julien looks at things, and how Bill then makes investment decisions based on that. But first, introductions. And we'll go to this direction. Julien, we go way back.
Yeah,
it's great to have you it's great to be on a panel with you again.
Likewise.
Introduce yourself to this audience.
Yeah, good morning, everyone. Thank you. So Julien Dumoulin-Smith, not a credit rating agency, but we write about the stocks, the publicly traded companies. So the whole litany of IOUs out there, et cetera. We've been doing it for a long time, almost 20 years here. And more to the point, we do buy, sell, hold, basically. And look, at the end of the day, you look at the stocks, you look at the way they're moving day to day, you might be mystified, but frankly, we're putting out recommendations. But we're really liaisoning between various communities to effectively introduce investors to companies and make the case. And we travel globally in the context, right? We really bring tangibly capital to the space in a very direct and specific way, and specifically utilities and the adjacent companies. So again, by way of background, we've been top rated for a decade straight here in utilities, #1 rated in utilities. So look, if you guys want to see what we're writing, shoot me a business card afterwards, or just shoot me an email, jds@jefferies.com. Happy to accommodate people's requests. But with that said, look, we write about this stuff every day. We've got opinions in every company. We've got ratings on every company. We don't hide what we say, or we don't hide what we think. Obi, over to you, sir.
Thank you, Julien. My name is Ugboaja. I'm a rating analyst director based out of New York. I work for S&P Global Ratings. I've been with S&P now for about the better part of 12 years. And prior to that, I spent several years in the industry. And so my career really began at the Tennessee Value Authority, the TVA, and that was in 2002, where I was hired as a rates analyst. And what that meant to me was we were basically tasked with doing research on tariffs, looking at rate design, doing cost of service for TVA, as well as the customers that they provided transmission and generation service to. As you know, TVA is a federally owned transmission and generation entity. And so around 2009, I transitioned to a water utility company in the Northeast, working for a company at the time called United Water. I believe they're called Veolia these days. And I was a regulatory sort of specialist doing rate cases, filing testimony, and doing the likes, that kind of work. And then somewhere along the line, I decided I wanted to try my hand in finance. But I knew I didn't want to be an investment banker. I wanted to do something somewhat sort of in between. And the rating agency sort of like approach and model sort of like appealed to me. And so I applied and looked to several opportunities, and ultimately ended up at S&P Global Ratings, and I've been there ever since. So that's pretty much about me.
Bill?
Great, thanks. I'm a little bit different, but so I started out where I had studied economics and accounting, and started out in public accounting. So I started working for PwC out of the New York office, and I was in the middle markets division, which was looking at small companies. But whilst I was there, I did work on the Con Edison account. And I loved the company, I loved the culture there, and I loved the industry. I really felt like they were providing a public service and really focused on doing it in a responsible and ethical way. So I reached out to my partner on the account and said, can I switch into this industry full time? Which I did. And then got to work on a number of other utility audits, got to spend time in Louisville, Kentucky, working on the EON entities out there, worked for MPCC, did a number of the independent power producers as well. But I also got a great opportunity where a fellowship came up with the EEI and AGA as the utility accounting fellow. So I got that role for 2 years, which was fantastic. You know, part of it was organizing conferences like this and getting the agenda set and all of the speakers and doing all of the behind the scenes things. So I know how much work goes into this. So really a tremendous job to everybody that's worked on this. But we also worked with the FASB, the SEC, the IASB, and really got all of the perspectives of all of the utilities around the country. And I think that's one of the benefits we have within utilities, is that we really can work more collaboratively than other industries have. We all have a unified goal. It's also one of the reasons I was so excited to be on this panel, because I really do see the value of these conferences, not just these panels, but all of the interaction and the connections that are made outside of this. And then my last role at PwC is I worked in SEC Services in their national office, and I got to read all of the utilities, 10Ks and 10Qs, and it's just as exciting as it sounds. And from there, I actually moved. I'm from New York, New Jersey area originally, so I actually moved to a client and went to National Grid in their accounting division. So I was a regional controller for New England, then New York, and then also got to do work on the integration of their renewable division. So got to go out to Minnesota. They had an acquisition of a onshore renewable developer. So worked in the finance department there. Then an opportunity arose at Eversource. So I came over to Eversource, moved to Connecticut, and there I'm responsible for transmission rates. So really the cost recovery of our large transmission projects. Oversee the formula rate process, oversee the financial aspects of our competitive solicitations, and then oversee the formula rate protocols, which I think a lot of people in this room are probably familiar with. But it's a broad process within there, and been there ever since.
Right on. Very good. Let's switch more specifically to what you do and how you do your job, starting with Obi. I think one of the misperceptions that we had to deal with, particularly again with state regulators, was that you were biased in some ways, and we had to kind of get to, like, you're the umpires, you're calling balls and strikes, you don't have any skin in the game other than that, but tell us about how you do your job.
No, thank you for the question. So let's talk about what is a credit rating. At its fundamental level, the credit rating is simply an opinion. It's an opinion on how we express the probability of defaults on any company, meaning, do we think that a transmission company A or transmission company B is likely to file for default on their bond issuance? And we express that alphanumerically or alphabetically, anywhere from AAA to the lower end of the spectrum, D. And so, but that's all it is. It is expressing our credit opinions as to the probability or the likelihood of default. Now, how do we do that? We do a traditional fundamental analysis, which entails looking at leverage profiles of all the companies we surveil. It entails lots of discussions with senior management teams to understand the direction that they're going with their businesses, to understand the regulatory dynamics that they're dealing with. We take in a lot of data. We have a sister company called RRA, where we sort of gather and assess a lot of regulatory information. And we sort of, like every analyst out on the street, Wall Street, we take in news information on developments as they arise. So we take all of that and we distill it and boil it down into the context of our ratings criteria framework and come up with a rating. And we express that opinion through our research updates. And so at the end of the day, that's really what a credit rating is. And we do this for over 260 plus companies across the US and Canada, including transmission companies, water companies, the electrics, you name it.
Very good. Julien, you too do your own ratings.
Yep.
How do you go about it? To what extent do you lean on information from the credit rating agencies to make those ratings? Tell us about your day-to-day life.
Yeah, wow, there we go. Let me make it more tangible in the context of, like, you look at equity and credit, and they're kind of interwoven. You guys appreciate this. Look, when I look at what Obi's doing, we actually monitor it pretty closely, right? Because I think at the end of the day, the stocks actually trade basically as a function of being able to maintain investment-grade credit ratings, right, across the board. This is a specific context for utilities. So generally speaking, utility credit quality is degraded substantively in the last few decades, right? And you've seen this ongoing trend. And I think at this point, what matters here to understand is that you're kind of at a minimum threshold, is what I'd call it. You've kind of whittled it down to the minimum latitude. And what I mean by that is you're kind of in this mid triple-B range for utilities. And why I frame it this way is before, and I say before, it's not categorical, but the vast majority of companies are in this range, such that, from an equity perspective, you can kind of assume that utilities are not going to forego their investment-grade credit rating. In fact, if you really parse this down, being at the bottom end of investment grade, so triple B minus as it's termed, really ends up being unpalatable because of their access to what's called commercial paper, and specific lending of last resort, right? So when you think about, specifically in this case, the financial crisis, et cetera, it really highlighted the need to be able to tap these credit markets and CP, specifically commercial paper. So really, the reason I give you this small tale is effectively you can de facto assume that utilities are not going to let their credit rating thresholds fall below a triple B threshold at this point. So in many ways, when we look at ratings, you can assume that the amount of leverage that a company is willing to put on is not going to fall below this threshold anymore. And so they're effectively going to equity fund. They're going to raise equity finance in order to sustain and backfill and satiate the very specific criteria and minimums that the rating agencies, including OB, are delineating. And so from my perspective, it sort of works hand in hand, because at that point, I can effectively say, look, here's the amount of equity they're going to raise. Now, historically, the alternative that I was getting at was that, a lot of these companies actually were like, well, maybe we don't need an A rating anymore. And so they would actually let their thresholds fall, and so therefore they would raise less equity than we thought. And so you've seen that pattern persist for some years. I mean, really, it's been a multi-decade trend. Look, in the last, call it a handful of years, certainly I think COVID accentuated this, frankly. That's when you really found yourself at this minimum threshold. In some respects, it's actually easier to really identify, like, what are companies going to do? Well, they don't really have a lot of choices. Again, I think, and this is also reflects, the latitude and the ease of raising capital for a utility being investment grade, it just doesn't make any sense to go any further. And more to the point, I think the perceptions as a function of that, you just underwrite it. Now, again, from my rating perspective, now I know how much equity they're going to raise, because their capital plans effectively back into an outcome that say, well, they need to maintain this specific cash flow to debt ratio is really what we're talking about, an FFO or some other permutation. But it's a cash flow to debt, right, as you would expect. How much cash flow do I have to service this debt, et cetera? You roll that through the model, and you effectively see the amount of equity they're raising. Now off of that, you can effectively create a trajectory of what their earnings, their bottom line, their profits are going to be. And it's off of that we delineate, right? Like, who's got a better growth trajectory? The equity markets are obsessed with growth. And so therefore, focus on, well, what growth can fall out of those parameters, A, and B, do I have an advantage or a disadvantaged credit profile? Maybe it's not the rating per se, but it's the specific metrics. Do I actually have an advantage credit metric or not? Ends up being a very clear factor in how stocks actually trade. And again, when we look at the utilities, I look at it often relative to one another. Why is ABC utility trading at a discount or a premium relative to another? It's often very clear cut as to why certain ones are or not. And then the last factor I throw in there is look, the rate of change, right? It's always about looking over the horizon. The stocks trade immediately. As soon as you smell blood in the water, the stocks are moving. And so I think that's where you think about risk parameters and ambiguities. That's really the core point that I'd leave you guys with. As soon as they smell this community changing on something, the stocks are moving. And often, again, I'd leave this observation to you guys. The utilities versus many other sectors across the S&P exaggerate changes in risk because it is such a risk-averse set of investors. Right, just understand who practically owns these things, and understand that because of that, when you do have these deviations, they reverberate in a way that, frankly, that butterfly might not have the effect in other sectors because you expect change elsewhere.
Right. Bill, how do ratings affect your life?
Oh, how don't they? I think
Yeah, exactly.
it is an area that we follow very closely. And following on Julien's point, if you think about the transmission space, it's a very capital-intensive industry. And it is dependent on access to the capital markets, and our ability to access cost-effective capital is affected by the ratings. So we work very closely. I don't really work directly, but I work through our investor relations group as well as your treasury group that I know you have a lot of communications with, and they'll, before they have some of those meetings, we'll have discussions just to go through some of the big things that are out there. Now, for Eversource at an entity level, our recent focus has really been on the balance sheet, and it really ties in with some of the things that Julien was saying, in that we're looking at some of those metrics. What are the balance sheet metrics? What are the credit metrics that come in? And trying to forecast and then give some visibility into what our plans are to OB, Julien, and the other rating agencies, so that they have an ability to forecast, and then, you know, here's what our strategy and plan would be, and they can monitor how we execute upon that. So I think that's, you know, really a key thing. And then from a FERC space specifically, some of the areas where we try and communicate kind of clearly, I really break it down into two areas. So one is really related to FERC proceedings, and then the other is just related to some of the large projects. Now, for FERC proceedings, I think Commissioner Lessert had mentioned one of the first orders that he looked at. They had a gazillion acronyms that came in, it was a few hundred pages, and I think that's by necessity going to be the way some of those orders are. So what we try to do, at least when I'm communicating to our Treasury and Investor Relations, is boil that down into kind of a concise summary. What is this saying? What are the key points within here? Why does it matter to us? And then what are some of the reasonable outcomes that we can see coming out of this? And what is the effect on us and on our customers as a result of some of these proceedings? The other thing that we have is major projects that are ongoing. Now, in the transmission space, a lot of the projects go on for a number of years. So we really want to make sure we're conveying to all of our stakeholders, you know, what the timing of those would be. So what is the cost going to be? What is the timing of some of those cash flows? What is the timing of the cost recovery for that? And also, what is the benefit to our customers for it? So we go through that whole process within there to really articulate the life cycle for those major projects, because they really do impact how we're evaluated.
Yeah, great summary. Let's talk specifically on how you deal with regulators, whether you deal with them or not. And I think you all do. But Obi, starting with you, how do you view state regulators, FERC regulators, without getting too specific? There's a wide variation out there.
Indeed, there is a wide variation. We monitor state decisions very closely. As you can imagine, 50 plus jurisdictions, including the Texas Railroad Commission, FERC. We monitor, I mentioned we have a sister company that aggregates a lot of regulatory information, a lot of data. So we're looking at that very closely. We're looking at all the rate cases, the rate case outcomes. We are looking at the legislative landscape. A lot of legislation has sort of like worked its way through the dockets, whether it's to deal with wildfire issues or other aspects that affect regulation. And we're looking at turnover within the commissions, and and with each election cycle, depending on the jurisdiction, you may have some turnover or maybe not. And so we look at all the decisions and all the development very, very closely. We look at FERC. And I would say that beyond just the numbers are important for us, okay? I would say that right now. The numbers are important for us, but also equally as important is the signal that the decisions sort of send from our perspective. And for us, that means transparency. We're looking for transparency. We're looking for predictability. We're looking for consistency in the regulatory framework. Because if you think about it, this industry is an industry that operates with negative discretionary cash flow. And what I mean by that is that when you look at your cash from operations and you subtract your capital spending and you subtract the amount of money, the dividends you pay to shareholders, there's negative discretionary cash flow. And how do you fund that? One of the ways is through equity, like Julien said. The other way is through debt. And so in any other industry, you wouldn't find investment grade ratings for companies that have these kind of profiles. And so what underpins that is the regulation, is the quality of the regulation, the stability of the industry that underpins the ability for them to kind of sustain investment grade ratings. So we are watching everything, and we do pay attention very closely to those decisions.
Again, a great message for regulators to hear, as well as this audience. Bill, how do regulatory actions affect your business and decision making?
So, no, they do greatly. And so we have state regulators and federal regulators, right? And we interact with them each differently. But I would say in terms of our interactions with them, our overall objective is going to be consistent, and that would be related to being transparent about what we're doing, why we're doing it, and what the benefits are to customers. Now, within there are certain limitations, like with the FERC commissioners, a lot of the discussions are going to be either contested proceedings or rulemaking, where a lot of the back and forth will be formal filings. So what we would try and do in those instances would be look for what would be useful to the regulators to make informed decisions on things. And you could hear Commissioner Lessert say he's very much into the economics, so we would try and put that into our filings within there. But we also want to be clear on how their results, their answers will, or their decisions will impact how we make investments. And if you look at our business and any utility, there is a finite amount of capital that we have. And we would constantly be looking at risk profiles and the return on that and making investment decisions based on some of those factors within there. So adverse regulatory climates or certain decisions that may be well-intentioned may have a detrimental impact because there'll be a reallocation of capital. So we try and be upfront with that, both at the state and the federal level. And we did have an instance in one of our states where there was a level of uncertainty related to some of the programs that were coming in, and we did not deploy capital to those programs and deployed them to some of the other states. So it's something where you're constantly looking at where to put that money. You look at the risk profile, and if you think about the transmission space, transmission projects are typically riskier. They are longer term, there's a lag on them. I think some of the people in the room had somewhere had challenging decisions on it. We'll be advocating for and needing some level of return that is commensurate with that risk that we're undertaking. And that absolutely factors into how we would be allocating our capital across our various different businesses.
Sure makes sense to me, yeah. Well said, Julien. You, I don't know if you watch state regulatory proceedings the way maybe Obi and some of his colleagues would on a real-time basis from places like Olympia or Springfield or San Francisco, but you probably do, knowing you. And
I mean, the joke is the stocks are moving faster than the credit ratings, right? I mean, let's be honest. In fact, that's actually maybe the key point, right? You say, like, look, are people, yeah, you better believe people are logged on to that. In fact, I think people would be shocked to see how many people are logged on from our community to these various filings. In as much as, like, look, you see very immediate changes, right? People, I think at times people underestimate what bombastic statements from the stand or whatever, do and have a magnified effect. And I think that's exactly it, right? I think this industry lends itself to very bureaucratic outcomes, and I think that's a positive, right? Because then you don't end up with statements that maybe were, flippant, if you will, or at times, right? And like, I don't mean to be pejorative about it, but I mean it in the context that I think it lends itself to careful judicial review, right? Which is, I think, exactly the process that is designed. But you make light of this concept of being, well, we're making decisions real time. People are reacting to that, right? If you're going to drop a number that's meaningfully outside of the norm, or even allude to the potential of that outcome, things are going to move immediately, right? And you'll be like, well, I didn't mean that. Well,
too late.
I mean, exactly. And that's where I think with times like the noise, the bands, right? I think, let me give you guys an analog here where I think it might be helpful. Think about utility investments as a bond analog, right? And you're like, well, obviously it's an extension of bonds, right? Basically, like the idea of this investment is a substitute for fixed income in many ways. Think about your own portfolios. If you invest in credit, look, I'm going to be very transparent about it. You invest in credit, you pay ordinary income tax on that, right? If you invest in a utility, the utility itself grows, its dividend grows, and you're taxed at dividend tax rates, right? Like, that's the value proposition. And you're investing in fixed income. Why? Because you want predictability. So if your proxy is predictability, then there's a hyper value, right? You think about volatility. You think about risk. Risk is defined as volatility. It's about the ambiguity, the outcomes. Zeroing in on specific outcomes has very tangible benefits. The ability to, like, I'll make it even more specific. The ability for a utility to grow at a very consistent cadence every year, year in, year out, makes it more bond-like, even more predictable. Yes, they're going to grow earnings every year at 6 or 7%, and that is the aspiration. And I think in many ways, like, it should be a collective appreciation. Like, the risk of the sector goes down the more that they're actually able to achieve a very specific prescribed outcome. And I think if you view it through that lens, you understand and get into the head of utility decision makers, i.e., if you can help them achieve the consistency, and maybe if you think about this as being a battleship that's turning ever so slightly, you can think about, hey, look, maybe this decision impacts them, in an outsized way immediately. Maybe that's not desirable, but maybe I can work with them on a multi-year basis to have an impact that's desired, mutually agreed. But look, at least they can adapt and manage around the situation, not just in year 1, but in years 2 through 5. And I think that's really important to consider, because I think that's where you get compromise. That's where you get regulatory outcomes that are mutually aligned. Because if you give the utilities latitude to work together on a multi-year, because again, most of these projects are not year 1 deployments. We all understand that these are multi-year projects, especially in transmission. And I think that's where it's so important. But again, the cost equity, whether it's the RTO adder or whatever, I mean, people are focusing on this, and they're making assumptions. You may not have said it on the stand, or you may not have heard it explicitly, but it was implied. We all heard it. Right? We're all making the assumption, right? Like it's not official. I don't care if it's official. The market's not fair, right? And I think that's exactly the point. It's immediately understood. And I think that's really important. And again, at the end of the day, the converse of this is in explaining and having context behind why certain decisions are going certain ways. So I think, cost equity is something that should be used infrequently as a lever, in as much as like making small gradations is probably important rather than making big swings, because I think that has an outsized impact. And I think also working hand in hand on designing projects and CapEx, that's really important. Like, if you don't want to do a project, what have you, it's not about sending a signal in ROE, it's about working diligently to recraft and re-narrate where things need to go. And I think that really helps to achieve like optimal outcomes. Again, all coming back from, like, what is the utility trying to achieve? It's trying to achieve a consistent, steady cadence of growth. So it can quack like, it can look and quack like a duck, which is basically a utility that's growing like a bond. That's what its aspirations are.
It reminds me of an event we had when I was on the commission, where one of the transmission companies had an order come out that was perceived as negative to them. Mm-hmm. And they lost $2 billion in market cap in about 10 minutes. And I said to the chairman, from now on, let's release these after hours as opposed to during the trading day. Bill, we're in this period now. We've alluded to it. We all know it. We've got demand has caught up with supply in various ways in various regions. Whether your jurisdictions are actively considering data centers or not, it's still part of the conversation. Affordability, as referenced many times today, is a major topic area that's really changed over the last 2 to 3 years. How does that affect what you do and how you do it?
I mean, that really is the biggest question that is out there right now. Affordability is at the forefront of every discussion that we have, factors into our decision making, obviously, and it's something that we consider and factor in. And I think you heard Commissioner Lessert say that FERC's responsibilities are primarily reliability and affordability. And we look at those aren't mutually exclusive, and they're not opposing factors. And we have to look at things kind of intelligently in the long term. Now, there's certain things where you could look at it and, defer investment and push things down the road. Now, that may have a short-term impact, but in the long term, if we allow our transmission system to degrade, that's ultimately going to be more expensive for our customers. So we really have to take that long-term view. The other thing that is important is really, it's going to be the theme throughout there, is just being transparent, right? And if you look at transmission and you look at a customer's bill, I think Larry sent something out that showed that transmission was about 10 to 20%. When we look at our recent bill analysis that we had done for Connecticut, it's about 14% within there. And some of the transmission investment, while it may increase that transmission piece of it, it may reduce some of the other pieces of it. So in New England, we had a tremendous amount of investment that we did in our system. That offset a lot of the congestion costs, which are almost nothing in the area. It also allows access to cheaper generation. So it has some of these other benefits within there. So really, the key is not to focus on that one piece. It's to look at the bill holistically. We're also looking at providing information to our customers, because we don't want it really to be a black box. I think Commissioner Lacerte said it well when he was saying, yeah, I get my bill, it comes in, why am I being charged for this? So we've tried to be a little bit more specific to show what are the various different components of the bill, what are people paying for? So specifically, transmission's 14%, distribution's about 30%, supply being a big factor within there. We also have a public benefits charge that's fairly large within our states. So we do want to make sure that customers are informed of those things. We also do want to look to say, well, are there additional services that we can provide? Can we provide metering that allows customers to make informed decisions? So that way, if people know what they're paying for and know what the benefits are, they'll be more likely to accept that. We do town halls on some of our projects, and granted, we can't do this on a macro basis, but when we go and speak to people, talk about a project, talk about how much it costs, people originally will come in a little bit antagonistic. As we walk through, here's what the bill impact is, here's the benefits of this project, people are much more accepted. So I think it's one of those things that utilities have to be focused on, is kind of improving that level of communication so people know it's an invisible product that we are selling. Right. So let them know this is actually what you're paying for, this is what the benefits are. And then also looking at, well, what are the levers that we can do to help affordability? And a lot of that, when Commissioner Lacerte was talking about efficient spending, that is a critical factor within there. Being smart about planning things. I think one of my colleagues always uses the term zero regrets when we're doing some bills. So if we have projects that we can right size for the future and do that now, that will stave off some future investment within there. And then really focusing on what are the areas of a customer bill that are impacted. And I know a lot of the focus, the easy punching bag, is always going to be the utility ROE, because that's something that's easy to attack. But whenever we do the analysis, any of the changes within there, they're really not meaningful to a customer bill. Now, we are focused on trying to do things that actually are beneficial for our customers, but we want to do that the right way and having something that actually will have an impact on the average customer. So I think that's really looking through, making sure they know what they're paying for, but then looking for ways to be efficient in that spending. I think we've always looked at it as there's really an arc within there. You want to get that right balance, and balance is the key. If you overspend, customers are paying for it. They're paying for spend that they don't need. But they're equally harmed if we underspend, because if you underspend, there's going to be degradation in the system, things will be much costlier down the road, your repairs are going to be over. So really trying to, A, find what that right balance is, and then B, communicate that to our regulators, to our stakeholders, and ultimately to our customers.
Well, if you can crack the nut on consumer education, customer education, I wish you the best, because the industry's been struggling for decades on that. And to some extent, it's a victim of its own success.
Yeah.
People have been able to rely on electricity without having to think about the thousands of people who make it run every second of every day, in the middle of the night even. And So, collectively, I guess I would include myself in this, we kind of rested on our laurels for a while, and now the hard work occurs. I was personally hoping we get some more dynamic pricing from states, but that's not going to happen in this environment, even though there's great potential there for shaving peak and moving consumption to off-peak. Julian, this situation, you're probably one of the few people who saw it coming, but a lot of us didn't. And how are you reacting to it?
Look, let's be honest, right? Inflation is a problem, and the affordability narrative is a problem. And look, I think as a function, let's be blunt, we're transparent about it, we write about it. I'll tell you guys, look, we view the sector kind of cautiously. Let's be honest about it. The sector valuations are difficult to stomach in spite of the backdrop with data centers and the acceleration. Why is that? Because you have states that are threatening to cut ROEs dramatically and undercut the backdrop, A, but B, look, the reality is the tension of inflation and affordability at the core of this is a problem. Now, look, let's talk about it. Like, what would I say back to this community in particular? What's striking from our community looking back in, right, this is sort of like looking yourself in the mirror, is like, look, where are a lot of these issues emanating from? It's permitting issues, right? Like, if I look at other angles, we don't just cover utilities, we cover the technology adjacent sectors. Look, there's a lot of technology to put to bear. You guys made allusion to this, but the point is, it's the permitting regimen, it's the inability for society to keep up with the technology that is actually really striking, right? Now, I'll say this in many ways, right? Renewable permitting, people say renewables, oh, well, we'll take away the tax credits. Look, the reality is renewables, look, what's the issue here? The issue with renewables is that we can't permit it, right? Understand it is a supply constrained environment. If people could buy more, they would, but they can't, so they won't. Understand that. And that's not a DOI comment. That's a broader local comment. Again, it's broader. That's A. B. Look, I mean, gas permitting is the fundamental challenge. You guys appreciate it. And I see it's getting worse. If you want to look in the crystal ball and talk about this, like, look, are things getting better or worse? Permitting is getting worse, right? I mean, the ability to actually interconnect renewables have gotten worse. That's an empirical statement, right? The ability to, now, look, the gas permitting, again, we could debate what happens on this front, but unambiguously, this challenge with, accreditation, ELCCs, and the power markets, I mean, look, that's a leading indicator. If you think you've got an issue on gas permitting today, wait till you see what happens when you actually raise gas demand at a high single-digit pace over the next decade, and then look at the other side of what happens to, gas plant accreditation, right? We think that, dispatchable generation is getting a value for capacity. That's yesterday's paradigm, guys. And so again, it goes back to the gas permitting. Like, again, I offer this to the regulatory community in an attempt to, like, just straight face observe from our angle where things are going and where the challenges are. And more to the point, you talk about tangible inflation. Inflation is going to manifest itself when ELCCs go down across the space and you continue to see capacity prices head higher. And that's not a PJM statement, that's just a broad statement across the country, because you guys know gas delivery is going one direction right now. A. B. Actually, renewables was A. B is gas. C is, look, transmission. Are we making progress on permitting? I mean, look, that's an open question back to you guys. Do you see that or not? Right? And again, I offer this all as, these are the faces of the challenges, and this is the community that, in theory, like, look, this manifests itself in specific pricing and challenges, and the stock's underperforming. I give that back to you as, like, a manifestation of what this community can see practically in our world and where the challenges are. Now, so I offer that as, maybe that's a challenge. That's a difficult assessment. That's a prospective statement that inflation remains elevated for a whole host of reasons. But look, I hear a couple thoughts. Data centers might be the challenge, but they're the answer, right? A constituency that is willing to pay and abundantly transparent in its efforts to say so. And frankly, look, they know that they're at the losing end of this socially, and they need to make a pivot. And that's what you're going to see, right? Is the data center answers, the jurisdictions that are most accommodating to enabling data centers, interestingly enough, are going to be the ones that are most able to accommodate the inflationary environment in energy. I actually don't think that's that controversial. It seems like it lands controversially. And a last point for you guys to observe is, if this wasn't existential enough, what's striking to me, if you take two steps back on the space, and again, we cover multiple, we're really focused on this behind the meter opportunity. What is behind the meter? Oh, well, we're going to circumvent the grid. What do you mean you're going to circumvent the grid? Well, we're just not getting timely access. Well, why aren't you getting timely? What are you talking about? This utility, it's a service. Well, we're still not, and we can't get it on a timely basis. I'm like, what do you want to do? Well, we're just going to create our own grids. Wait, you're going to do what? At what price point? Yeah, we're going to go do that. Right now, I tell you, I think these are great investments. I'm not being facetious with you. I'm telling you genuinely. How can you, as a utility guy, say it's a great investment when you know it's a big premium? Yeah, but what's the timeline that we're going to get this stuff resolved? These companies are legitimately saying we're going to sidestep. And the issues and the morass that's created, whether it's permit, it comes from FERC or it comes from the RTOs or in Texas, which I get is not FERC jurisdictional, et cetera. Look, that is all actively, right? You think this is yesterday's problem, we're on top of it, we're going to fix it. Look, guys, like 2026, this has been the year in which people have made pivotal decisions to go off grid. It is actively happening now, and they're hedging their bets. Understand that that's a cautious statement and reflection of where we stand now and the decisions that have been made year to date, not yesterday. And I would observe this, as I was talking to another data center friend of mine, he was like, look, this challenge has gotten worse, right? This started in Northern Virginia, and we thought, oh, well, we might need to go behind the meter there. And then people were like, well, that'll resolve itself, we'll figure it out. No, it's actually metastasized, to use the expression, where it's gotten worse and spread, where people are like, no, well, the Northern Virginia example, I actually want to go off grid elsewhere, and I see the challenge in Northern Virginia, and that's becoming my problem now. Again, I highlight the issue in an effort to get ahead of it and understand the big picture, because that's where we come from. We look at the stocks, we look at investing. We're agnostic to investing in utilities versus other sectors, and we're saying, look, understand that it's going against the sector writ large. They say the first step to a problem is identifying a problem. I want to throw it to you guys that at a big picture, this is not a good trend. This is not something the industry should be embracing. And more to the point, you should call a spade quickly in understanding that this is a trend that is rapidly moving against the space. So, third point.
Okay. Obi, how do these trends affect your decisions in terms of your industry outlook and the assessment, specifically for transmission companies?
Okay, wow, that was fantastic here. So we recently revised the outlook for the utility sector to stable, but I don't think that tells the whole story. The reason why we are at stable now is because for 5 of the last 6 years, the number of downgrades have outpaced the number of upgrades. And so we are at a point where a lot of the degradation has occurred. We used to have a median rating for the industry at A-. Now it's mid BBB. And so you're not that far away from sort of the line for what it means to be an investment grade rated utility. And so we are stable for now. We think that CapEx is going to continue. Affordability is an issue. We're looking at every management team that comes to our offices. We expect them to have a clear, articulated strategy around what are you doing about affordability? What's the regulatory strategy around this issue? Do you have alignment with your regulators? Do they understand where you're going with this? And so those management teams that don't have a clear answer to those questions, we have serious conversations with them because there's a clear issue around affordability. We started to see it, we've seen it in different moments in history. We saw it in 2021 during COVID when there was moratoriums against disconnects. We've seen it during Storm Uri when a lot of mechanisms were put in place to kind of help mitigate the costs of the storms. But now it feels like it's sort of like gained full steam. And we saw it in New Jersey with the gubernatorial race there, and it just seems like it's spread like wildfire. Speaking of wildfires, that is a risk that we're watching, right? And so specific to your industry, right? It's transmission lines, after all, are the lines that do fall down and obviously ignite wildfires. And so we are watching that very closely. It's a big risk, and it's not just California. We're seeing it in places like Hawaii, Colorado, Oregon, and the list goes on and on. And so, in addition to the affordability discussion, which is very relevant, we are also probing about wildfire risk mitigation. How much spending is going into mitigating wildfire risk, and what's the strategy around that to sort of like reduce your exposure. So stable, but watching all these emerging trends.
Got it. Obi, I spent about 5 years of my professional career, and the issue I spent the most time on was wildfires. And before you mentioned it, I was thinking, this is the first panel I've been on in years without the mention of wildfires. So I am glad you brought it up, but it's with mixed emotions that it affects me. We've got about 7 minutes left for Q&A. Larry, you want to start us off, please?
Yeah, thanks. This is really great and a little scary, perhaps, but there's a lot to absorb from what you all just talked about. We're going to open it up questions. I'm going to go ahead and start. I'm going to go circle back to the comment I made to the commissioner, the question I made to the commissioner earlier. I guess I'm like a dog with a rag on this one, but it was really striking to me that report that came out from Fitch, and maybe they're somewhat of an outlier perhaps on it, but I did get some of this from you, Julien. I'm curious as to what the others think. The word that they used was deteriorating. I find that kind of an alarming word, actually, and particularly in an industry that tends to be pretty risk averse for the most part. Are we looking at it sounded to me like, Julien, you're saying this, a little bit of a downward trajectory for the industry, given some of the challenges they're facing? I'm curious as to whether you think that's the case or not. If it is, what are the consequences of that going to mean for those of us in the room and some of the investment in major infrastructure that we're looking to try to make? And are there any steps that can kind of mitigate or maybe even hopefully reverse that trend if that's the case?
Yeah, look, I don't want to be alarmist. I want to flag real issues to you guys to be tangible to walk away from. But look, at the same time, let's be honest, it was best of times and worst of times. The best time, look, this is the highest earnings growth rate the sector has ever seen. Writ large, this is unparalleled. Again, I say ever. Maybe 60 years ago you could write something comparable. I would suspect not, right? I truly actually think this is record, right, for the industry all time. And so at the same time, you're like, what are you complaining about? Look, I'm looking at valuations, I'm looking at investments, and I'm looking at what the issues are. But at the same time, look, let's acknowledge where we are, right? This is incredible, this backdrop. Power demand growth, and specifically having large concentrated needs of power, not distributed, makes it incredibly difficult to accommodate, but more to the point, creates an opportunity. And it creates an opportunity for cost allocation. Look, I will say this, the single, if you talk about a panacea, there's not often a silver lining or a silver bullet. Look, there is in this case, I would argue. It's the closest thing I've seen to a silver bullet in a while, right? And the silver bullet is cost allocation of data centers, right? This constituency knows it's playing defense. Forget utilities playing defense. The data center community is playing way more defense right now. Let's acknowledge this. And so to that end, their willingness to absorb disproportionate costs is transparent and obvious. And in this sector, and I would challenge you in the transmission space, have we actually figured out transmission cost allocation back to data centers adequately? I would argue no. And I would argue that is the single most tangible opportunity. As I think about transmission investing, it is clear cut. And redesigning and getting ahead of tariffs, frankly, before, look, I'm just going to call a spade. Look, the reality is consumer advocates are going to step up on this and ask for this. But I think there's an ability to be proactive and get ahead of these issues. And that's what I would offer to you guys as an observation from an outsider in looking at this. Look, it's a great opportunity to enable investment, to effectively create knock-on benefits to other constituencies. And it's about ensuring that the large loads not just pay for themselves, but actually contribute. If there was to be, at times there's a legal threshold, is it a net benefit or not? I dare you to impose that threshold here in asking about how things are offered up. Is it a no harm or is it a net benefit? And I think in this moment in time, I think there's probably something to be evaluated here. So I offer that as look, I don't mean to be doom and gloom unnecessarily. I offer that there is something to be done here, and I think there is a solid solution. And look, let's be honest with ourselves. I'll offer this as a further point. We're talking about data centers. What is the cadence of data center builds, right? I think I offer this in as much as this is an accelerating trend. We're going to see more announcements, not less. In as much as even the data center announcements that have been made take years to ramp up, offer arguably 5 or 6 years of rampant phase-in that arguably continue to give you visibility on that growth and the ability to allocate incremental cost, incremental revenue back to the space. That is a long-running cycle, and it hasn't run its course yet, both in terms of actually phasing it in, obviously, but also in terms of incremental announcements for sites that gives you an extension of that load growth forecast well into the end 2030s. It's exceptional visibility for the sector. It's an exceptional moment to rise to, and it's an exceptional moment to allocate those costs right at the outset, which is still today. So, hopefully.
I can follow on just a little follow-on point there, because I think you mentioned it. There is a lot of risks that's identified in that report, but I think one of the things that I think is prevalent today is there's also a lot of opportunity right now. And if you're looking, the one thing I think everybody is agreeing on is that there is a unprecedented and tremendous need for new transmission to be built. There, between aging infrastructure, load growth, electrification, and uncertain energy policies or new sources of generation, there is a defined need that everybody agrees on. So then it gets into how do we enable and incentivize that? And then the rub on it is the other piece that Julien is touching on. The affordability thing is overhanging everything. So if we can figure out ways and have strategies that can do that, and there's multiple opportunities to fix or at least mitigate some of that bill growth and some of those affordability concerns, that would then breed a ton of opportunity within the space. So that's where I think actually the near-term horizon, if we're building transmission, is fairly bright.
Obi, we're basically out of time, but I'll give you the last word.
It's been a very exciting time for me as a credit rating analyst to be following the sector. I think that if you ask me, well, which one do you think is riskier, building a transmission line or building a nuclear line or nuclear assets? Or I would say, ooh, of course, you know the answer to that. And so I think it's an exciting time to sort of like be in the transmission space. I agree with all the comments made here today. I think, like going back to my point before, when done right, when there's consistency and predictability and transparency of the regulatory framework, we view that all else equal, it's a really sort of like stable and lower risk situation. The outliers, like I said, we continue to watch and monitor, but I think that lots of opportunities out there for growth, and so yeah.
Very good. I didn't mention that I serve on the board of Babcock and Wilcox, and we're taking advantage of it. We can build speed to power better than anybody else, so it's a great opportunity for us because we have the turbines. But nevertheless, I've thoroughly enjoyed this panel, being the moderator for them and for you, and I had a hunch they were going to bring it, and they brought it. So please help me in thanking these three great people.
Great to see you. Thank you for the time.
Thank you guys, and Phil, thank you for moderating a really great panel. We're going to take about a 15-minute break, so go get yourself some coffee or whatever, and we'll be back in about 15 minutes for the next panel, which I'm really looking forward to.